Hello everyone, Alex Kim here. What we're observing in the silver market right now requires a level of attention that most participants aren't applying yet, and that gap between what's happening and what's being noticed is where significant moves tend to originate. While broader market discussions focus on equities and policy headlines, something quieter but more structural is unfolding in silver. The metal is being treated less like a commodity waiting for direction and more like a target asset where multiple demand vectors are converging. If your analysis stops at the price chart, you're observing the shadow rather than the structure casting it. I'm recording this on Friday, January 23, 2026, at 08:43 a.m. local time. Recently, a Dutch silver museum experienced a significant theft where hundreds of historic silver pieces disappeared in minutes. This wasn't selective acquisition. This was systematic removal. As silver prices rise and become more prominent in public awareness, incidents like this don't merely represent criminal activity. They represent market signals. When criminal incentives shift rapidly, they're responding to perceived value and liquidity. However, that incident should not distract from what's occurring in the financial markets themselves, because the market tape is transmitting two conflicting messages simultaneously. One message suggests stability. The other suggests structural stress beneath the surface. The productive approach is to examine the moving components and reassemble them in a framework that reflects actual mechanics rather than narrative convenience. First, the broad setup. When yields rise, the dollar typically receives support. When the dollar strengthens, precious metals typically face headwinds. That's the standard relationship. What makes the current environment unusual is that the textbook framework remains present, yet the responses are inconsistent. We're observing sessions where bonds exhibit volatility. Equities remain resilient, the dollar weakens, and metals refuse to collapse in the manner that historical correlations would suggest. That combination indicates that the simplistic model where one variable controls everything is losing explanatory power. I want you to focus on that phrase, losing power, because silver is uniquely about power in both the literal and metaphorical sense. Literally, silver is essential to electricity, conductivity, grid infrastructure, solar installations, electronics, sensors, medical equipment, and data centers. Simultaneously, silver represents trust in a tangible form through coins and bars for individuals who distrust digital representations of value. That dual identity is why silver is particularly dangerous to misunderstand. A useful mental model is to think of gold as a fireproof safe and silver as a fireproof safe that also functions as a toolbox. People reach for the safe when they fear systemic risk. Industry reaches for the toolbox when it's scaling infrastructure. When both groups reach for the same object simultaneously, you don't get orderly price discovery. You get friction, and that friction manifests in unusual places initially, such as premiums over spot, delivery timelines extending, lease rates tightening, and inventory disappearing without broad public acknowledgement. Most market participants never examine those indicators. They observe a spot quote on a screen and assume that screen represents the complete reality. It does not. This is not a retail story. Now let's discuss intraday price action. You'll observe silver declining sharply during US trading hours, then stabilizing or rebounding as Asian markets come online. What matters is the pattern itself. If price declines are being absorbed quickly rather than cascading further, that communicates that the market is encountering genuine demand that doesn't evaporate when a headline shifts. This is where the tension between physical and paper markets becomes relevant. Futures markets can move price with speed and leverage. Physical markets move price with stubbornness. Leverage can push price down rapidly. Stubbornness pulls it back gradually. The critical question becomes, what happens when the stubborn side becomes more stubborn at the exact moment the leveraged side becomes more fragile? That's when you stop observing clean corrections and start observing gaps, and gaps are where positioning becomes painful. Why is silver receiving increased attention now? For years, silver was treated as the secondary asset relative to gold. That's changing because global infrastructure is being rebuilt and silver is embedded in that rebuild. You don't modernize electrical grids without conductive materials. You don't scale solar capacity without the material that converts light into usable current. Silver is used in solar cells, electronic solder, contacts, and numerous components that aren't optional if the technology is expected to function. A typical solar panel uses a small amount of silver, and manufacturers have worked for years to reduce that amount per unit. Here's the complication. When you multiply a small amount by hundreds of millions of panels, the aggregate becomes substantial. If installations continue climbing, the industry can reduce silver per unit and still consume more metal overall. Then there's the electrification ecosystem around electric vehicles and charging infrastructure. The surrounding ecosystem consumes silver in power electronics, high-reliability contacts, charging hardware, grid interconnects, and sensors. Silver isn't included for aesthetic purposes. It's included because failure carries significant cost, and conductivity combined with corrosion resistance delivers reliability. Beyond energy, silver possesses antimicrobial properties, which is why it appears in medical coatings and water filtration technologies. It's utilized in RFID systems, switches, high-performance bearings, and the invisible components of devices that must operate reliably for extended periods. When you aggregate all these applications, you recognize that silver demand doesn't depend on a single product category. It's distributed across the infrastructure of modern economic activity. Here's where a common trap emerges. People hear the term industrial metal and assume that characteristic diminishes silver's value as a store of value. That logic is inverted. Industrial demand doesn't weaken silver's monetary function. It competes with it. It establishes a floor beneath it. It means silver isn't merely stored in vaults awaiting sentiment shifts. It's being consumed. Gold is predominantly hoarded. Silver is used, dispersed, and partially lost. Some portion is recycled, but substantial quantities end up distributed across devices where retrieval isn't economically viable. Historically, silver functioned as money for thousands of years. In the United States, silver coins circulated widely until debasement caused the metal to disappear from circulation. That occurred because the metal became more valuable than the stamped face value, and when that threshold is crossed, coins vanish. So when people claim there's abundant silver available, what they often mean is there was abundant silver when demand was substantially lower. Now let's connect this to current market narratives around tariffs and trade policy. When policymakers signal potential easing of trade tensions, markets often interpret that as reduced inflation pressure. That interpretation can trigger selling in metals, particularly those tied to manufacturing like silver. Here's what you need to retain. Headlines can shift expectations for a week. Infrastructure requirements can shift demand for a decade. That's why you observe violent selling on a headline, followed by a stable bid underneath. Fast money sells the narrative. Slow money buys the underlying reality. Watch the flow, not the headlines. However, silver sits inside a three-way tension between monetary fear, industrial demand, and speculative leverage. Sometimes fear drives price. Sometimes demand drives it. Sometimes leverage drives it, and then punishes all participants when it unwinds. One of the pressure points is copper. Copper functions as the circulatory system of electrification. If copper supply tightens, manufacturing costs rise. Because a substantial portion of silver supply is produced as a byproduct of mining other metals, including base metals, constraints in base metal mining can indirectly squeeze silver supply. Here's the element most participants miss. Silver miners are not the exclusive source of silver. A significant portion is produced because mining operations targeted other metals. That means silver supply can be surprisingly inelastic and slow to respond to price signals. Even if silver becomes more profitable, you cannot instantly activate production if the primary mine economics are tied to zinc, lead, copper, or gold. When silver demand accelerates, the supply response lags. That lag is where volatility originates, returning to the museum theft because it carries significance people prefer not to acknowledge. When a valuable object becomes easier to sell, the incentive to steal it increases. When the object is not only valuable, but also liquid, portable, and globally recognizable, it becomes optimal for criminal activity. Silver satisfies those criteria. The theft isn't merely about art, it's a market signal. More participants believe silver will retain value going forward, and that belief fuels market transitions from quiet to chaotic. Let's discuss silver's dual nature. Silver can behave as a productivity metal when the world is building, and as a protection metal when the world is experiencing distress. It's not confined to a single function. That flexibility explains why silver can move explosively when conditions align. However, flexibility operates bidirectionally. Silver can also be punished when traders need to reduce risk quickly. Because silver is smaller than gold in market size and more volatile, it becomes the initial target when large participants require liquidity urgently. The question isn't whether silver is favorable. The question is what phase we're in and what type of participant you are. If you're a short-term trader, you focus on momentum, positioning, and catalysts. If you're a long-term holder, you focus on gradual structural shifts, supply constraints, industrial adoption, currency debasement, and how trust is evolving globally. The next significant move in silver might not originate with silver. It might originate with something that appears unrelated, such as unexpected volatility in credit markets, a sharp movement in energy prices, a surprising inflation print, or a geopolitical development. Silver doesn't need to be the initial catalyst. It simply needs to be among the assets that possess both industrial utility and monetary characteristics. This isn't speculation. This is positioning. So, what should you monitor? Watch real rates. If inflation operates above yields, the real return on cash becomes negative, and that environment typically pushes participants towards scarce assets. Watch the dollar, but also watch how confident the market remains about central bank control. When confidence erodes, gold usually moves first, and silver often follows with greater magnitude. Watch energy prices because energy functions as the hidden cost embedded in everything. Watch equity market sentiment. When equities feel invincible, metals can feel irrelevant. When equities feel fragile, metals feel like an exit mechanism. Now, structural supply-demand points. There's silver above ground, but how much is available at current prices is the operative question. A metal can exist and still be unavailable because it resides in products, private holdings, and industrial inventories. Availability is not equivalent to existence. Higher prices won't instantly create additional supply. New mines require years to permit and construct. Because substantial silver production is byproduct-driven, supply increases depend on the economics of other metals. Silver is not simply a less expensive version of gold. Gold is predominantly monetary. Silver is monetary, industrial, and consumable. That makes silver's price behavior more chaotic, but also provides multiple pathways to upside. The market is in a tug-of-war, and the tension is increasing. You observe it in intraday volatility. You observe it in how rapidly narratives shift from pessimism to optimism and reverse again. That type of emotional volatility typically occurs near inflection points. The conditions are conducive to surprise, and surprise generates the largest moves. When GDP revisions, inflation data, and employment numbers are released, they don't merely move markets because of the figures themselves. They move markets because they alter the prevailing narrative. The narrative drives positioning. Positioning drives flow. Flow drives price. Price drives headlines, which reinforces the narrative. It's a feedback loop. This is where ratios become informative. If you only examine silver in dollar terms, you're evaluating the metal through the lens of the currency people are questioning. When you compare silver to gold, silver to copper, and silver to energy, you begin to identify when silver is relatively cheap or expensive compared to the physical economy. Historically, the gold to silver ratio has oscillated. When that ratio extends excessively, it typically doesn't remain there indefinitely. It reverts. The reversion can occur even while gold is rising because silver can rise faster. A ratio is a temperature gauge. Currently, the ratio discussion is returning because more participants are recognizing silver isn't merely gold's secondary asset. Silver possesses its own demand engine. Another dimension is inventories. When inventories are comfortable, the market can absorb shocks. When inventories are tight, the market becomes reactive, and minor triggers can create disproportionate responses. Substitution is real, but it's neither instant nor costless. Engineers don't redesign supply chains immediately. In sectors where failure is catastrophic, such as power systems and medical systems, companies pay premiums for proven solutions. Digital assets can serve purposes, but they don't conduct electricity. They aren't soldered into circuits, and they aren't consumed by industry. They can compete with the monetary narrative, but they cannot compete with the industrial narrative. When one asset has two demand engines, it doesn't need to dominate every discussion to dominate the trend. Even if certain tariffs are softened, the global system is moving toward redundancy and resilience. Resilience is expensive. Expense translates to increased capital spending. Increased capital spending translates to greater materials demand. That's a gradual tailwind for silver and other conductive metals. The energy transition isn't exclusively about vehicles and solar panels. It's about data infrastructure, data centers, artificial intelligence compute, networking, cooling systems, and hardware scaling. Every wave of digitization carries a material footprint. The cloud isn't weightless. It's warehouses filled with machines. Machines require metals. The public narrative lags the positioning. Gold functions as the gravitational center in the precious metals complex. When gold trends, silver often functions as a multiplier. What's particularly notable is when gold maintains strength during periods when it theoretically should weaken, such as when yields rise. That can signal underlying demand that isn't merely speculative. Central banks have strong incentives to diversify reserves. Gold remains a global settlement asset in a manner nothing else replicates. Silver doesn't occupy that same role, but silver benefits when confidence in paper assets erodes because silver is the accessible hard asset for a broader population. Even if gold is the central bank asset, silver can be the crowd asset, and crowds matter when supply is constrained. The largest silver moves often initiate after the market convinces participants nothing will occur. It creates complacency, it compresses volatility, it eliminates impatient holders, then it breaks. If you're monitoring silver daily and experiencing numbness, exercise caution. Numbness is how markets construct traps. Miners are enterprises with costs, timelines, political risks, and management decisions. When metal prices rise, miners can benefit, but only if they control costs and avoid disruptions. Energy costs impact mining margins directly. If metal prices rise faster than energy, margins can expand dramatically. Silver is among the few assets where the value narrative and the utility narrative can reinforce each other. If silver gains recognition as an improved store of value, people hold more, reducing available supply. Reduced available supply increases sensitivity to industrial demand. Increased sensitivity creates sharper price movements. That's reflexivity. However, feedback mechanisms can reverse, which is why risk management remains essential. When something becomes both valuable and scarce, the population divides. One group concludes it's too risky. The other group concludes that's precisely why they want exposure. The second group often drives the trend because they act while the first group hesitates. Silver has been in that transition zone for an extended period. It was ignored, which made it safe to ignore. Now it's being noticed, which makes it dangerous to ignore. What I'm monitoring is whether sell-offs continue being absorbed quickly, whether silver holds key levels after volatility spikes, whether industrial metals remain supported despite macro headline swings, whether the dollar can sustain strength or continues fading on rallies, and whether the market begins pricing an environment where cash yields less than inflation erodes. Markets don't require a single mastermind to create pressure. Leverage, incentives, and crowd psychology can produce identical outcomes. The bigger force is structural. When demand rises and supply is constrained, price performs the rationing function. That's commodity mechanics. Price rises to reduce consumption or increase supply. If consumption cannot decline easily because the metal is essential, price must rise further. If supply cannot rise quickly, price must rise further. That's mathematics. Institutions don't chase price. They manage exposure. Exercise caution with binary thinking. Reality is more complex. Segments of the economy can slow while others accelerate. That complexity is precisely why silver's dual identity matters. Silver can benefit from growth-driven spending and also benefit from fear-driven hedging. If silver functions as both a technology enabler and a protection mechanism, what occurs when the world simultaneously demands more technology and more protection? That's not hypothetical. Infrastructure build-outs, security concerns, currency pressure, and global competition are occurring concurrently. That's why silver appears pulled in opposing directions simultaneously. When an asset experiences strong tension from multiple directions, the release can be violent. Stop anchoring on single-day movements. Don't commit exclusively to any single narrative. Decide whether you're trading or holding. If trading, establish rules and respect them. If holding, don't permit short-term noise to dislodge you from a long-term thesis. Recognize that liquidity events occur. In genuine panic, nearly everything sells initially. That doesn't invalidate the thesis. Understanding that prevents emotional ambush. Those museum artifacts were created by craftsmen who assumed their work would outlast them. It did for centuries, then vanished in minutes. That's what volatility does. It compresses time. Markets operate identically. If you're treating silver as dormant, you might be operating in the centuries mindset, while the market is preparing to act in the minutes mindset. Silver doesn't move first. Stress does. When the next significant move arrives, it might not provide a clean entry. It might gap overnight. It might surge on a day when the news appears unrelated. People who waited for perfect confirmation will end up buying higher or not participating. The silver market exists at the intersection of three forces that rarely align perfectly: industrial necessity, monetary distrust, and speculative appetite. When only one force is active, silver can move, but the move tends to be contained. When two forces activate simultaneously, silver can break out of range. When all three forces activate together, silver doesn't just move, it dislocates. We may be approaching a period where all three forces are strengthening concurrently. Industrial demand continues building as electrification scales. Monetary distrust is rising as fiscal deficits widen and currency debasement concerns grow. Speculative appetite is returning as participants recognize the setup. If those three forces converge with intensity, the resulting price action won't resemble normal volatility. It will resemble a structural repricing, where the old anchor points no longer hold. That doesn't guarantee it happens tomorrow or next month. It means the probability is rising and the conditions are aligning. The question is whether you're prepared for what that looks like when it unfolds. Stay alert, stay humble, stay curious. Everything discussed here is for educational purposes, shared as commentary and analysis, not as financial advice. And you should always conduct your own research and consider your personal situation before making any decision.